What if the next billion-dollar stock is sitting right under your nose? Peter Lynch, one of the most successful investors in history, believed the secret to beating the market wasn't hidden on Wall Street. It was right in your everyday life. Lynch managed the Fidelity Magellan Fund from 1977 to 1990, delivering an average annual return of about 29%. That's not just impressive, it's legendary. But here's the thing. Spotting a great product or company is only the beginning. In this video, we're breaking down Lynch's simple, three-metric approach to turning everyday observations into market-beating investments. Let's see how you can find your own edge as an investor, starting with what you already know. When it comes to spotting future winners, Peter Lynch's philosophy stands out. Everyday people have a real edge in the investing world. He called it the everyday investor advantage. Lynch argued that you're surrounded by clues, products you use, stores you visit, brands you see gaining popularity among friends and family. These aren't just part of your routine, they're early signals that can point toward companies with real growth potential. Lynch's core idea, summed up as invest in what you know, is straightforward but powerful. He believed that the best investment ideas often come from your own life, not from some secret tip or complex analysis. Regular people, by paying attention to the businesses they interact with daily, can notice trends and rising stars before Wall Street analysts do. But Lynch was clear. Personal experience is just the starting line. He always stressed the importance of following up those observations with some basic financial checks. That's how you turn a hunch into a real investment idea. Take Lynch's investment in Dunkin' Donuts as a prime example. He didn't just like their coffee, he noticed something specific. Long queues and a steady stream of repeat customers every morning. That wasn't just a sign of popularity. It was proof of strong brand loyalty and consistent demand. This first-hand observation sparked his curiosity, but Lynch didn't stop there. He began digging into Dunkin's business model, checking how well the company managed its costs, how much it reinvested for growth, and whether it could keep up that momentum against competitors. Lynch's process shows that noticing a trend is just step one. The real advantage comes from combining what you see with what you can learn by doing your homework. It's easy to assume that simply liking a product means you've found a winner, but Lynch warned against jumping in too quickly. He condensed this lesson into one key point. Enjoying a brand or seeing it everywhere is not enough. Before investing, you need to spend a few minutes reviewing the company's financials and growth strategy. Lynch often said that the average person can spot a trend early, but to make it pay off, you have to confirm that the business behind the trend is actually solid. Lynch also believed that professional investors sometimes miss these opportunities because they're removed from the daily lives of consumers. While Wall Street analysts are buried in spreadsheets, you might be the first to notice a restaurant that's always packed, a product flying off shelves, or a new app everyone's talking about. That's your everyday advantage. But it only matters if you back it up with research. The real secret in Lynch's approach is this. Let your daily experiences guide you toward potential investments, but always follow up with a closer look at the numbers. He recommended reviewing a few key metrics after an initial observation, just enough to see if the company is financially healthy and poised for growth. This habit bridges the gap between noticing a great company and actually profiting from it. So if you've spotted a company that seems to have momentum, what comes next? Lynch would say this is where you roll up your sleeves and start looking at the numbers that matter most. Let's talk about what really set Peter Lynch apart. His focus on three simple numbers that helped him decide if a company was just good or truly a great investment. Lynch didn't believe in drowning in data. Instead, he zeroed in on the price-to-earnings (PE) ratio, the price-to-sales (PS) ratio, and profit margin. Mastering these gave him an edge, and you don't need a finance degree to understand them. First up is the price-to-earnings ratio, or PE. This shows how much investors are willing to pay for each dollar of a company's earnings. Lynch liked to keep it straightforward. A PE under 15 was usually a bargain, and anything over 40 was a red flag that the stock might be way overpriced. For growth stocks, he felt a PE between 15 and 25 was reasonable, but you always had to ask, are expectations getting out of hand? For example, in 2021, Tesla traded at a PE near 300, which meant investors were betting on massive future growth. Apple, by comparison, had a PE around 20 that same year, suggesting a more stable and grounded valuation. Lynch used the PE ratio to quickly judge whether a stock's price matched its real-world earnings power. Next, there's the price-to-sales ratio, or PS. This tells you how much you're paying for every dollar the company brings in from sales. Lynch's rule of thumb: a PS under 2 often meant the stock was undervalued, between 2 and 5 could be fair depending on the industry, and anything over 10 was getting pricey. To put this in perspective, Zoom Video Communications had a PS above 40 in 2021, a sign that the market was hyped about its growth, but also that investors were paying a huge premium. Meanwhile, Ford's PS was under 1, pointing to a more cautious view from the market. Lynch liked the PS ratio because it helped him spot companies that were delivering strong sales without getting swept up in market excitement. Finally, let's look at profit margin. This is the percentage of revenue a company keeps as profit after covering all its costs. Lynch considered a profit margin above 10% strong for most industries, and anything above 20% excellent. A low margin, under 5%, meant the company was barely scraping by. For example, Apple's profit margin hovered around 25%, showing just how efficient and profitable it is. Amazon, on the other hand, had a profit margin closer to 6%, reflecting its strategy of reinvesting heavily in growth. Lynch paid close attention to profit margins because they revealed how well a company could turn sales into real, lasting profits. The real power in Lynch's approach came from combining these three numbers with what he observed in everyday life. If you noticed a business booming in your area, these metrics let you check if the stock was actually a smart buy or just riding a wave of hype. Let's say you spot a company that everyone's talking about. You'd use the PE to see if it's trading at a reasonable price, the PS to check if sales are backing up the excitement, and the profit margin to make sure it's not just selling a lot, but actually making money. Getting comfortable with these numbers gives you a big advantage. You're not just guessing or following the crowd, you're making decisions with real information. But Lynch's strategy didn't stop there. He was famous for finding companies that grew not just a little, but by 10 times or more. So what's the secret to spotting those rare, explosive winners? That's what we'll dig into next. Let's get into what made Peter Lynch's strategy so powerful: finding what he called 10 baggers. Lynch actually coined that term to describe stocks that go up 10 times in value. These weren't just lucky picks. For Lynch, 10 baggers were the foundation of his success, and he often held on to these stocks for years to let their full potential play out. From 1977 to 1990, he delivered an average annual return of 29.2% managing the Magellan Fund, while the S&P 500 returned about 13%. That kind of outperformance came from spotting a few big winners and having the patience to let them grow. So what did Lynch look for in a potential 10-bagger? He kept it simple but focused on three key traits: consistent earnings growth, a business model that could easily be replicated or scaled, and a durable competitive moat. If a company checked those boxes, it had a real shot at massive long-term gains. Consistent earnings growth was number one. Lynch wanted to see companies that could increase their profits year after year, not just in a single lucky quarter. Next, he liked business models that were scalable, meaning the company could expand quickly without costs ballooning out of control. Think of software companies or franchises that could open new locations with a proven formula. Finally, Lynch always checked for a durable moat. This could be anything from proprietary technology to strong brand recognition, economies of scale, or a powerful distribution network. If a company could defend its turf and keep competitors at bay, it was much more likely to sustain high growth. Nike is a classic example straight from Lynch's playbook. He invested in Nike when the company was riding the wave of a growing fitness trend and starting to dominate the market with athlete endorsements. The partnership with Michael Jordan, for instance, turned Nike into a cultural force and gave it a huge edge over rivals. Lynch recognized that Nike wasn't just selling shoes, it was selling a lifestyle, and its brand was becoming a moat that competitors couldn't easily cross. Over the years, Nike's stock price exploded, rewarding investors who had the foresight and patience to stick with it. But Lynch didn't just look at numbers or flashy products. He described each investment with a clear narrative that explained the company's competitive advantage and its path to growth. For Nike, The story was all about capturing the fitness movement and leveraging star power to build an unbreakable brand. For other companies, it might be about solving a problem in a unique way or dominating a niche market. Lynch believed that understanding this narrative was just as important as reading financial statements. If you couldn't explain why a company would keep winning, it probably wasn't a 10-bagger. Patience was the final ingredient. Lynch knew that even the best companies take time to reach their potential. He encouraged investors to hold on through the ups and downs because big gains rarely happen overnight. Nike's rise wasn't instant. It took years of steady growth, smart marketing, and reinvestment to become what it is today. Lynch's approach proves you don't need to be a Wall Street pro to find 10-baggers. Everyday investors can spot them by paying attention to the world around them, then digging into the company's fundamentals to see if the numbers and the narrative line up. It's not about chasing hype, it's about recognizing real, lasting growth and being willing to wait for it. The real challenge is pairing what you notice in daily life with a disciplined look at the facts behind the company. That's where Lynch's method stands apart, and it's a mindset anyone can start using. When you look at Lynch's track record, his real advantage was blending personal insight with disciplined financial analysis. By combining what you know from everyday life with the 3 key ratios and patient research, you can spot undervalued companies with real growth potential. As Lynch said, the key to making money in stocks is not to get scared out of them. Staying patient and sticking to your research matters most. Try this. Pick a company you use all the time. Look up its numbers, run through Lynch's 3 metrics, and see what you find. Drop a comment below with a product you're curious about and plan to research this week.